Hello, everybody. It's just shortly after noon Central Time as we are diving into the webinar today. So just to go over a couple of housekeeping things and then we will dive in. I'm pulling up my screen here so that I can make sure I cover some particular items today. So how we're going to use our time is you can comment at any time, and I'm going to pull that up here as well on my other screen so that I'll be able to see that bigger than the camera here that is recording me. And so you can ask questions at any time today. I may not be able to answer them in the moment, but I do want to get to a space for that Q&A later in our webinar. So please feel free to jump in and to be able to maximize that benefit, taking advantage of that live chat. So if you got a question, feel free to use that. Now, what we're going to cover today in the financial webinar, and where my focus is going to be, is on budgeting and savings tips. So we talked about in a previous webinar a lot about budgeting. I want to lean into some savings strategies today and talk about spending and how to be able to put some practical techniques in place that can help you. And so in just a moment, we'll begin to dive into that. I'll tell you a little bit about me if we've never met, and then we'll dive into those strategies today on the webinar, get to the Q&A, and then when we wrap it up today, we'll talk about other resources and next steps available to assist you in your personal finances. So a little bit about my backstory. Let's begin to go into that. And if you're jumping on later, of course, or jumping on halfway through, you can reshare this or watch the replay as long as Facebook keeps it up in the original channel this is being released. So a little bit of introduction and about me, and we'll dive in. So welcome, first of all, to the webinar. I thank you and appreciate you for taking the time. My goal, even though the cost of admission to this was free, is to make it well worth your time. So what can you do to make this free webinar valuable to you? Well, there's a little bit about human psychology when it comes to the cost of things. In order to get something out of something, we have to pay a cost. So there's no monetary cost, but here's the cost I'm asking you to pay as we dive in today. I'm asking you to go ahead and grab something to write with. Grab some paper, grab a pen or a pencil, and be able to jot down actionable steps and things that stand out to you. In a coaching session with somebody yesterday, actually an initial coaching session, the objective during a half-hour time with this gentleman was to identify 2 to 3 actionable steps. I asked lots of questions in a first meeting to be able to serve best. The more I know and the clearer picture I have, the better I can serve. And we walked away with about 7 or 8. And I asked him, was that, walking away with 7 or 8 actionable things you can do to improve your financial situation, your goals, is that overwhelming to you? We far exceeded the goal of 2 or 3 in first time meeting in that case, but that's because he gave me such relevant information and he's ready to go. I said, is that overwhelming or is that empowering? He's like, that's empowering. So that's my hope for you today. I can't guarantee the exact number, but I do hope you have at least 2 to 3. I think it's much more likely if you're here for the whole time, you might have 6 to 8 like we talked about. So come ready, willing to pay the cost of your attention and being ready to jot stuff down. It is best to be able not to be listening to this in the background, but to be fully present. And again, on a replay, you can do 2 times speed and all that types of stuff to maximize your time. But today, we are going to pay that cost together of putting in high intention and high quality coaching and content in the midst of this webinar. So we're going to explore some effective budgeting techniques, smart saving strategies, and address some of the most common financial questions that folks have and face when they are talking about their spending, their saving, and their budgeting. And budgeting, to some people, can feel like a 4-letter word. It's not something that's particularly fun if you're not used to planning or if you've never done it before. It's a skill that is learned over time. But whether you are just getting started or you're looking to fine-tune your financial skills, there's going to be some valuable insights that are going to support your financial well-being. So a little bit about me. My name is Ryan Marks, and I grew up learning about financial principles largely from my dad. That was like just something that he was really into. And I remember I would get my allowance, and I get my $1 when I was really little, like 5 or something like that. And I would put my 10 cents in, literally we had a bank, put my dime in a church, a giving category, put 10 cents in a savings category, and put 80 cents in spending. And what I always wanted to do when I was a kid, and I always tried to find loopholes, is I didn't like the saving part, and the giving I didn't have an issue with, but I wanted to find ways out of it to be able to draw on that savings and have the dollar to go to the Dollar Tree and buy myself some plastic cowboy and Indians or something to play with. I didn't want to wait. I wanted to spend. And I was exposed to the teachings of Howard Dayton, Dave Ramsey, Howard Dayton, and others from a very early age in life. And later on, my parents really began to dive into Dave Ramsey's process. I myself went through financial peace while still in high school. And so we switched away from the allowance methodology of teaching us financial principles into straight commission. And to be honest, this is where I began to learn more principles. Now, Dave's teaching on this and how he kind of explains it is you don't get paid being allowed to live. That teaches something fundamentally errant to children. People don't pay you to live. You don't get just supported by society. You get supported on if you work. So straight commission. And when I began to do that is actually when I became more motivated. So I remember I wanted to open my first bank account. And my dad told me that before he would go down with me to the bank to do it, I had to earn $100. I was motivated, man. I was working hard. I think I was making like $3 an hour, helping do, projects around the yard and different things. I was doing everything I could, and I saved up. And when I got to that $100 and then was able to open my bank account, that really meant a lot more to me. And I had to put in the effort to do it. And so when I had to earn the straight commission aspect and a goal I was trying to achieve, the motivation was much higher than when I had the allowance and was focused on spending. That was an interesting, psychology of money thing there that I learned at a very young age without even knowing it. Now, I still remember the first and only debt that I ever had. It was to my mother, and it was for a video game I wanted to buy, and it was like $30 or something like that. I only had, I think, maybe 5, and my mom made me a deal. She would buy it, but I would have to pay her a certain amount per week until and pay it off. It was really more layaway than a debt before I could actually have it. And actually, by the time I got that video game, my mom would not let me pay extra. I had to pay it over the period of, I think, like 11 weeks or something to pay the remainder of it and what the amount she would allow me to pay. And by the time I actually got the video game, I didn't like it. It didn't work too well on my computer. And I learned that I don't want to be in debt. And the big moral of the story, whether my mom realized it or not in that situation, was she wouldn't let me pay it off earlier, even if I found other ways. And I was trying everything I could. Could I find a penny here or there? Could I do anything to get free of this debt and to get the game earlier? And since there was no way to do that, I learned the slavery of debt, which is how the Bible speaks of slavery. It's bondage. You're continuing to make that payment. And since I was unable in that situation to free myself earlier, like Scripture exhorts and encourages, if you can get free earlier, then do so. Have that gazelle intensity, as Ramsey calls it, to really dial in and find other ways to increase the income and pay it off quickly. That's another thing that will motivate. When I'm coaching and talking with folks that have debt, I can tell if they're intense and ready to make, adjustments. Just talked to somebody yesterday that is looking at taking on a second job so they can take care of some debt. And really, they can take care of it pretty quickly by doing that. And they're motivated and they're ready. Now, long term, if you're working 2 or 3 jobs, that gets to be a huge burden if you're doing that just to survive and pay the bills. The hustle culture in that sense is not good long term. But short term, it's very motivating to get out of bondage and begin to build some margin to live free. And so that is another lesson I learned from my parents. And then I also learned Ramsey's principles of financial peace, as I mentioned, in high school. And really what that just further did for me is it it continued this mindset of I want to stay out of debt. I want to manage what I have better. And by staying out of debt, that allowed me to be much more effective with my bachelor's and my master's degrees, not going into debt for those. I actually exchanged labor for my first car. I worked over like a summer basically to rack up a total amount of earned labor to trade for a car rather than paying money is how I did that the first time. So I thought outside the box. And because I did not have debt from my education and those other things, it doesn't mean that I never made a poor financial decision. Really, there was a time where even though I always bought my cars used and paid cash, I really shouldn't have bought it. I can think back at one time that, it would have really been more cost effective to pay for a small repair on a car rather than buy a new car. But I didn't do it. In terms of some of my getting started and in my retirement savings and stuff, I was way too conservative. When I started saving retirement funds when I was younger, I kept way too much liquid in cash because it was a mental thing. I was afraid of not having a certain amount super liquid, and I sacrificed a high yield savings, a safe place to put it, and I sacrificed being more age appropriate in my risk tolerance for beginning my Roth than I should have been. And so I didn't make every decision correctly, but the debt freedom allowed me then to be able to serve in ministry bivocationally. And I did that over the course of about 15 years, beginning in high school. And so I did that on the side, and then even transitioned to 5 years where I focused specifically on church revitalization, was able to go in and help churches that were on the verge of shutting their doors. I think of one church I served and never even had a budget. This church had been around for over 150 years, and nothing I could ever find in the records seemed to point to the church ever having had a budget. So just a simple thing of helping a church have a financial plan and plan for how they're going to be doing things was extremely empowering. So these principles work not only for the individual, but for organizations. And I'll talk about that a little later. But how did I transition from a ministry world to financial services? Well, as I mentioned, my dad instilled that in me, and so it's become second nature. I've eaten this stuff up. I love it. It's something that is always, if you will, top of mind, how to be better stewards, how to help people in this area. And I spent some time in the world of teaching and the financial education world, part-time financial services world, and I decided that I wanted to switch over to the financial services and the coaching area. I did explore the insurance and investment world and was going down that track, but there were a couple reasons why I decided not to continue that. One was I really wanted to coach and empower people to take ownership of their own finances. I wanted to educate and empower and help someone grow in those habits rather than do it for them or be the one they look to just transactionally, here, invest this for me, here, get me a rate on insurance. I wanted much more than that. So that was part of it. The other part was I experienced a question and kind of a mini crisis. I mean, it wasn't a literal crisis, but it was something I wrestled through where I was working for an organization in the financial services arena that professed to be a Christian organization, and yet they openly had all the DEI training, they endorsed that, they had all LGBTQ wing. They claimed to be neutral on what they called social issues like LGBTQ, pro-life. So they had an LGBTQ division. They were supporting that, with financial dollars of the organization, and yet they would not support anything pro-life. And it was an issue that not only was the company doing this and claiming to be Christian, and I am a Christian. That's not a Christian stance, but then there was a further on the compliance side of what would I even be allowed to do in terms of volunteering without pre-approval. And I didn't want to go down that path of a lack of integrity. So to have integrity, I decided to go with Ramsey's organization and to get his training as a financial master coach. And I am a part, at the time of this recording, I am a part of their Ramsey for Preferred Coaches Network, and so get leads and that type of thing through them. So that's a little bit about my background, of how I got into this, lessons I learned growing up. I know that took a several minutes as we got started, but let's now roll into what's going to work for you. Now, there may have been some tips in my life story of, hey, that was thinking outside the box, and hey, you actually got through college without debt. Love to have that conversation with you if you or someone that you know and love is in that chapter of life. I did just talk to somebody recently that they weren't debt-free getting out of college, but they did only have a few $1,000s worth of debt. So it is possible to either get through debt-free or minimize that depending on some things you do. Let's talk about the importance of budgeting though, and then we'll move into some saving and some spending tips as we move in today. So this is going to be about 5 minutes overview of really what I spent a whole hour doing a webinar on last time. So I'm not going to go as deep in budgeting. You can go back and find that recording or reach out to me and I can get that for you. Budgeting, though, is the cornerstone of personal finance. It's the foundation. This is like the habit that drives all the other habits. So what budgeting simply does is it allows you to track your income and your expenses. And the ultimate goal is a zero-based budget. In other words, every dollar has a name and you're not in the red to cover your four walls. Your housing, whether that's mortgage or rent, your utilities, to be able to have heat, to be able to have electricity, those things to take care of your family, to be able to take care of your transportation to and from your job. Many people need that. You might be able to use public transportation, but you would still have to pay for it, have a transportation pass or something, and to cover your groceries, being able to eat. Those are your four financial walls of essentials you need. Other things beyond that are really more optional. You can choose whether or not you have Amazon Prime. You can choose whether or not you have different subscription services and pay for, the latest and greatest phone upgrade, whether you decide to play video games, whether you rent a movie, whether you decide to eat out at a restaurant. Those are fundamentally choices that are discretionary, at least in a healthy financial picture. If you're at the point where you cannot put food on the table and cover your four walls, then we really need to look at your budget, because either there's discretionary spending taking this away or there's debts that are eating up payments. You're in a real serious situation if you cannot cover those four walls. That is the first place to start. Then beyond that, we can get into some other strategies. But what the budget does is it helps you look at those areas. And there's nothing wrong with the things I mentioned before. It's not bad to eat out. It's not bad to have a subscription or to have some type of streaming service or to even decide that you want to get a phone on a more regular basis. That's fine, but let's do it in a way that does not continue to build financial strain and increase a huge number of payments and debts mounting in the background, looming and hanging over your head. That's a very bondage-driven way to live. You're never going to really achieve true financial freedom, peace of mind, and the flexibility to do some pretty cool stuff in your generosity and your lifestyle if you are living that way. You'll never get ahead if that's the way that you're living. So the budget helps that. It helps you look at reality and set realistic goals that are based on actual information. How much money are you actually bringing in? And then you can begin to make short-term and long-term financial observations. When you first start it, you're going to be able to see some short-term stuff like, hey, I think of someone I was coaching, they didn't really have any emergency funds. It literally was initially just getting food on the table. One simple tip we talked about, and this really moves into the other category, but I'm going to say it here, is shopping with a list. They were shopping more, going to the grocery store and what looks good, and they're going when they're hungry, and that's a way you're going to end up spending more money. The other thing they did is they didn't really have a full-fledged budget, but they were able to take a look back at their statements of their spending, their checking account, their credit card, that type of things, and they were able to look back, where am I spending money? And wow, this was automated. They found some nice savings just by canceling some automatic subscriptions they didn't even know were still taking place. And then after about a month and a half, they were in a position where they finally were experiencing some margin. They made huge financial wins by simply going with a budget and having a basic meal plan, knowing types of nutritious meals that were fairly easy to prepare, and that they could go shop for those ingredients by having a list of some of those things. And then maybe you even say something like, I'm going to jot on a piece of paper, maybe not every meal, but you can be that detailed if you want. But hey, Friday night's going to be frozen pizza night. So when I go to the store, I'm going to look for the pizzas on sale. I'm going to buy a couple of those and throw them in the freezer. Hey, I'm going to do this. I'm going to get pot pies. I'm going to get some soups. I'm going to have a grilled cheese and tomato soup night. You pick some different simple meals, and then you go shop for those items. You look for the sales, and you can save some more even there. And we'll get into some of that more in the next part today. But by that simple thing and canceling some subscriptions they didn't even know going on, they for the first time were looking at reality of their finances and able to then begin to save. They actually were beginning to have some margin. And so they had some emergency funds, and it reduced the stress. The other thing is having a full cupboard of groceries, it does something amazing for peace of mind. If you're living paycheck to paycheck, if things are very tight, this one tip of shopping with a grocery list, having some form of a meal plan, whether that's completely or you just identify the types of meals you enjoy and have those ingredients and those resources or frozen items or cans of soup on hand, having that makes a tremendous difference in then giving peace of mind, having a full cupboard. And then you're beginning to set aside a little bit of savings, and it increases the peace of mind. Then you begin to start thinking about short-term goals. Is there a debt that you want to pay off? The budget drives these things. Now, there's different budgeting tools. Let me talk about that for just a moment. There are tons of apps out there, and if you like that method, great. There's the Every Dollar app out there. There's a bunch of others too. Every Dollar is the one that Ramsey's organization has created, and it has a lot of really cool features that have come out now where it can do some assessments and help see where some areas based on a short little assessment you're going to fill out that's fairly full-orbed and detailed, going to help understand, is there a way you can save? Is there a way you can maximize how you're doing some things here? And so it's real helpful to have that system, that program, be able to run that for you and give you some suggestions. But there's nothing wrong with old-fashioned paper and pen. There's nothing wrong with keeping actual receipts. There's nothing wrong with an envelope system and paying cash for things from certain categories. Like, here is my clothing budget, here is my food, my grocery budget for the month, and having that type of a way. That's a way to help really track your discipline. Having a check ledger, for lack of a better term, or just a piece of paper where you're writing every single thing down. Going into your bank statement and following it that way and doing everything from a debit card and a checking account as opposed to credit cards. These are ways that help you look at what are you actually spending, and then, okay, is my spending and my income remaining where I need it to be? If there's extra that I'm not spending, hey, I got savings. And then if there's extra I'm spending, I don't have savings, okay, don't have the income for it. I either need to draw that from savings, or I'm unfortunately going to end up in the red line of some type of a debt. And we want to avoid the debt. We want to find habits to be able to live in the beginning at our means. Every dollar has a name, and then below our means, so that we can have that margin that gives us opportunity for generosity, for investment, for thinking of the future, for better protecting our family, perhaps in terms of coverages. Like, if we don't have life insurance, if something happens to you as the income earner that your family's dependent on, they're going to be in an even worse situation if something happens to you unexpectedly and that income is gone. So life insurance, disability insurance, but those are things that do cost money. They're not typically super crazy, especially what I would recommend going with term life insurance, but they are something you'd be able to pay for, but it's a huge, huge benefit to your family. Now, at some point, you can be self-insured, where you have the savings and you're living below your means. And even though there would be a financial impact to something happening to you, your family being able to be okay even without that income, that's a great place to be. So the zero-based budget is giving every dollar a name. The budget is a tool to help you to manage your outflow and your inflow. And if you will, like this glass of water, it's fairly low right now. If I keep pouring into it and then I'm drinking some, If I drink it until it's completely empty, I've used everything. I actually can't drink any more water than is in this container. I can't go into debt in that sense. It is simply an illustration to help us understand that the budget is a system. There's a container, and then how is that being used? And then, hey, I got some margin. That means I can use that for something else. The other thing I would recommend is a dashboard review, and then we'll move into the spending and the saving tips that I want to spend most of our time on today before we get to Q&A. So a dashboard is simply having a system, whether it is your apps, whether it's you log into your online banking services, taking a look at your retirement funds, logging into those accounts, using something digitally logging in, or whether it's looking at the physical statements or having a register that you have entered from the cash and receipts in front of you. The simple thing is this: have some type of habit for a dashboard review. Now, if you have the app type of thing, it can make it a matter of a few seconds or a few minutes to pull this up and look at it all. Especially if you're using some type of digital app that you put your actual budget into, and then after it learns what bills go where, it puts them in the appropriate categories, and you see how you're doing compared to your different categories. It's like a digital envelope system is a way to think of it. Whether you're using that or you're looking at paper, and I've done both, I actually tend to do one part of my life more on paper and the other part of my life more digitally, and that, I prefer to do it that way. I've tried a lot of different systems, but that dashboard review allows me to know where I'm at, and then I can make strategic decisions. Whether I'm looking at business finances or whether I'm looking at personal finances, it helps me to have then the metric of knowing, okay, where am I going? Here's my personal budget, here's my business budget, and then what are my next goals? And then that plan allows me to move forward. So let's move into the second section now on saving tips, and these will apply no matter what your lifestyle is. There is, first of all, an old adage, but it's true: pay yourself first. Set aside a portion of your income for savings. Once you have established the basic budgeting where your four walls are covered, if you have debts, your minimum payments on your debts are, and you're living below your means, once you have a handle on that, now you can really begin to make decisions that have tremendous long-term impact. And it begins by being able to pay yourself first. You're not able to pay yourself first if you're living beyond your means. You don't have any category really for being able to enjoy some mad money or some spending money, whatever you want to call it, some blow money. Being able to have that in the budget, $200, $400, whatever it is a month, $100, $50, having that money to just do whatever you want with. Hey, I want to go out and get a burger. Hey, I want to go to a movie. Hey, I want to rent a movie. Hey, whatever it is. I want to go drive go-karts this weekend. Having that gives you the freedom to enjoy it. But when you don't have that, you're not really able to enjoy paying yourself. But paying yourself is an important financial principle. Once you get the budgeting, and it doesn't have to be perfect, it's never perfect, but once you get that habit built and you've made traction, you're actually having margin, now you can start looking at paying yourself. And this is where simple savings and spending tips go a long way. First of all, yeah, it's perfectly fine and a good thing to allow yourself some money to spend. Perfectly a good thing. Having that in your budget, a dollar amount that you can call it whatever you want. Your blow money, your mad money, your spending money. But you can spend it how you want. And if you don't spend it, great. You leave it there and you save it up for a couple months. You can do something bigger. That type of a thing. But the other part is, when you pay yourself first, and you can automate this with the tools out there today, which makes it great, you can actually begin to dramatically and compoundingly increase your long-term future. Here's what I mean. There are banks out there that will take your debit card and round your purchase up to the next dollar and put the difference into your savings account. There's cash back debit cards out there. I recommend debit rather than credit so that you're not going to build another debt. The debit is just taking it out of money you already have in a checking account, in a banking account. And so it's just drawing out funds you already have. Begin to maximize those benefits. But even more than that, at your employment, and this is around open enrollment time at the time of this recording, open enrollment's pretty soon. Does your employer offer you a match if you put into your retirement account? If they do, that's free money. Now, if you're living beyond your means, you don't have the ability to really take advantage of that. But if you're living below your means, hey, take advantage of that. If you put in 4% and they put in 4%, you're now setting aside 8% of your income. Let's do some simple math here. Let me grab a calculator. Let's do some simple math. Let's assume that you make $50,000 a year, and we're going to put in 8% of that. That's $4,000. Okay, but if you only put in 4%, so that's half that. You put in $2,000 over the course of the year, and your company's putting in $2,000. You get the free money of their match, plus you get the growth, plus depending on how you set up that account and what options are available, you can maximize your tax benefits potentially enormously. So if your employer has a Roth option, would highly recommend taking that. It means you pay the taxes now, but then it grows in retirement, you take it out tax-free. That's the way it's set up now. It's a pay the tax now and don't pay it later. There's the other options out there, traditional 401ks, traditional 403bs, traditional IRAs. Those accounts, you get to take a tax deduction on that money you're putting in, deduct it from your income, and so you're not paying taxes on it, but then it's going to sit there and it's going to grow in a retirement account, and you're going to have to pay taxes on it when you retire. But you're going to be paying taxes on it and all the growth. Be a great thing if you have a Roth option, do that first. If not, it's still worth it to take advantage of the free money. And so pay yourself first through that simple way. Great way to get some free money, and then the compound interest. Depending on what your work has, if it's through an employer, you probably have a couple of options, or you potentially have no options. You might just be putting the money in and then they invest it or have it managed by some firm or some option. Or they may give you some options like you can invest in certain mutual funds. My encouragement to you is take advantage of that and invest as diversified as you can. That's the simple financial tip that's going to be how to minimize your risk. Diversification simply means I'm spreading my money out, investing into multiple things rather than investing in one. So for example, if you work for a company that gives you stock options or a stock bonus or a stock purchase plan at like a discount or something, it very well is probably worth taking a look at the details of that and seeing if it makes financial sense for you. It very well could. And the thing then to look at is to talk to your CPA and figure out with a stock option plan, what's the most effective time from a tax perspective to sell that and get out of that? Because it's not diversified. If you're buying your company's stock or you're getting it as a bonus or whatever, there's probably some tax ramifications of how long you hold it before you sell it. And you want to talk to your tax preparer to make sure you make the right timing on that to avoid some extra taxes. But the point is, a stock that you own and a bunch of stock in one particular company is not really a very diversified plan. You're putting all your eggs in one basket. If that company goes down, and I think of something that actually happened with my dad growing up. He worked for an organization that was affected by the whole Enron thing a couple decades ago. If he would have had a bunch of stock in Enron, or if somebody else did, and then that happened, you lose a bunch of money. So there's risk there. However, if you have a mutual fund, one fund where you have a share of it, and there's 100 different companies within that bulk portfolio is what a mutual fund is. It's mutually funding multiple stocks, multiple bonds across multiple companies. And you even can get like an S&P 500, one that mirrors the S&P. You can get one that's a certain sector like a technology mutual fund, a healthcare mutual fund. But even if you're doing that, diversify. Don't put all your money in healthcare investments. Don't put all your money in technology investments. Diversify it. Because then when one section of the economy is struggling more or might not be really producing returns or even some losses, you have other areas that are hopefully performing better to help balance out overall. Plus, the other thing is hold long term. So diversify, minimize your risk, get out of the single stock game. That's extremely risky. That's like gambling. You're putting all your eggs in one basket. Spread your eggs to multiple baskets. And then the power of compound interest. It grows over a period of time. The stock market, if you look at the S&P 500, the stock market over its history has done like 11.5% over its whole history on average. So yeah, if it went down 40% one year, or it's recession, or it almost looks like it's crashing, and you pull out, then you're going to experience a big whammy. But if you can have a long-term view, there's on average that much growth per year. That's tremendous compounding effect. When you have $2,000 in there and you make 10%, so you made $200, and then the next year, so let's say you didn't put any money in, you had put $2,000 in, and then you had gotten $200, 10% growth, so you have $2,200 in there, and the next year, let's say that the stock market does 9% instead. Well, you made $198. On top of that, $220 already in there, so now your original investment of $2,000 by year 2 is up to $2,398. Did you notice it's only a $2 difference in the rate of return from the previous year, 10% versus 9%, because of the effect of compound interest. You're making interest on the interest when you reinvest that. And so there are ways to get that working in your favor. What can you do to manage your spending? Cut unnecessary expenses. I think of one of my clients that did that recently. They looked at their bank statement and they found areas where they didn't even know they had some recurring subscriptions, and they cut them out. I think of somebody that's making some lifestyle decisions where they're going to put on pause a hobby that they have that costs a good portion of money. They're going to put that on pause for a little while so they can clean up some debt. What things can you cancel? What things, just little habits, can you make that can save you money? If you get coffee every day, if you buy a little coffee maker and make it at home, you will save a lot of money. Starbucks or whatever, Dunkin', you'll spend $7. Maybe you drink the cheaper coffee. You're still spending something like $5 a day. That really adds up. If you're doing that every day of the week, 20 times, let's say a month, 5 days a week, 4 weeks out of the month, $5 times 20, that's $100 you just spent on coffee. You can probably go and for under $15, get yourself a nice big old bulk coffee grounds thing and do it at home. You can even get the Starbucks coffee or whatever if you want that costs a little bit more and make it at home, and you can save a lot there. Another thing, eat out less. Are you buying lunches? Lunches can cost $15 or more these days. The cost of eating out is getting really expensive. Now, there's ways to minimize that and reduce the cost. Get the app, especially if you're doing fast food. They almost all have apps, and they got rewards, and you rack up points, and you earn free food or free, coffee or whatever back. That's a way. Minimize it. Even if you're going to choose to continue to eat out, find a way to lower that bill and to cut unnecessary expenses, or pack a lunch. Find simple lunches that can be warmed up. Even buying frozen TV dinners could be cheaper than eating fast food. Now, neither one of those are probably the healthiest options. I'm just saying there are ways that you probably can make a difference. And like the $5 illustration I just showed, you might make $100 difference a month. A couple little habits like this, it can really begin to add up. You go through this exercise, you might save $400 or $500. You had no idea that you had margin in your budget. Another thing that coincides into this, I think about someone I was coaching recently. They lost their first and their second job. They had a full-time job and they had a second contracted job that was part-time. And they lost both of them within a short window of each other due to downsizing on the one and contract changes on the other. They've been a long-time contractor with that other second job. And so one of the things they began to do is they looked at their budget. And to be honest, what they found is they didn't really have a plan for how they were using a lot of their services. They were trying to support organizations and different things that they believed in. And if you will, you could almost say they were probably taking the more extreme view of trying to be socially conscious with every dollar. Great motive behind that, but they were so fragmented and all little piles of money and little automated things were going out all over the places. They found tremendous savings by canceling a bulk of it. And then by just simplifying their life. They had so many subscriptions and services and apps and softwares they were subscribing to. They literally reduced a lot of that. And it also lowered their anxiety level of all that they were carrying. So there were a lot of mental health benefits and things through that exercise. And again, they were doing this in wake of, hey, a couple weeks I'm losing my full-time job shortly after having lost the other. And so they began to go into that mode. Now, then we also began to discuss how are ways to go about the job search wisely and proactively as opposed to just shotgun approach. The average job out there that gets a resume submission, there's 400 resumes. There's hundreds of resumes on an average job application that goes up, a job posting, when you post it. Now, there are ways that you can maximize that. There's different types of services and things you can do. There's different ways you can follow up. There's ways to differentiate. And so I would encourage, if you're in the job, if you've lost a job or you're in a job search mode, because that does overlap with our finances, because most of us earn our income from our work, or maybe we're retired now where we're living off of different benefits, and hopefully we have multiple streams of income, work retirement, personal retirement, assets we've built up, Social Security. We have all these different diversified. If everything is coming from one source of income, like just Social Security or just a pension, then there is some risk. Because what if a payment's not making it with the government shutdown? What if a pension, what if that company goes defunct, or the pension manager didn't manage the funds appropriately and I lose everything? Even if you have a pension, which is a phenomenal benefit, have other things in place as well. That's the way to protect yourself. But where I was going with that is, even if you find yourself in a job loss or a job search situation where you want to change jobs or take on a second job, I'd love to talk to you about that. There's some strategies I can go deeper in that I'm not going to really have time to focus on today. But these financial ones of going through and finding where you can cut expenses and where you can pause stuff, it can make a difference. This is one that comes up a lot when I talk to people, is the area of your cell phone. A lot of folks still have contracts with phone companies, a major carrier, and they're paying for a plan, and they have, potentially fines, penalties for canceling that contract early. Really what you've done is you've gone into debt. You've committed to pay a certain amount of money. If you don't have it, you're still going to have to pay that in that contract or find another service to switch to. But my point with it is, a lot of people are paying tons of money. It's not uncommon to see folks spending $100 on their cell phone bill. And yet there's a lot of no contract carriers these days. There's a whole bunch of them out there. But I know multiple folks, multiple different services, they're paying $25, $30 a month. They're saving like $70 a month, $50 to $70 by switching carriers. I know people that have done that when they're looking at the unemployment type of situation to lower their bills. I know people that are looking at debt repayment and, hey, I can save money there. Home internet is another area. Do you have a good value there? Are you paying for cable that you don't need? Is there a lower package on cable? Could you stream stuff for free with a few ads, or a much less expensive streaming service? How can you change those subscriptions or even cancel them outright and do something else that's going to allow you to really make a difference on your finances in those areas? Another tip on your saving and your spending: shop smart. The little habit that I talked about of using a grocery list, that one, it makes such a difference. I can't tell you how many people I've talked to that works. One thing for myself and my own family that we've begun to do, we were doing a lot of our shopping at a major discount store. And I won't name it, but it was a major discount store, and that's how they position themselves. Like, they don't have grocery bags or stuff. You have to bring your own or buy them. But what I was finding is the produce wasn't always the best, and the cost was going up, even for stuff there. And I saw a recent study that was done that a major box store actually was cheaper on a lot of common household items than that. Furthermore, I then saw a local ad come in our mail for a local grocery store. And I got the app, and this store had just phenomenal. The produce was better, and I actually ended up spending way less for higher quality items and even more name brand stuff. Not that I buy name brand, we don't buy name brand stuff all the time, but there was buy one, get one free over Labor Day weekend. I went to buy some groceries, and they had like a buy one bag of chips, get 3 free deal. Now, not the healthiest food, but that was a tremendous deal. And so I took advantage of that. And so I've just begun to use them for most of our shopping, because you download the app in that case, and they have their weekly ad, and I can clip the deals digitally in the app, and then it goes to my account. And when I check out, I just put in my account number on the keypad for my rewards account. And there's 2 things I do. One, I get all of those discounts applied. And if I was to just go shop in the store, there are discounts you get just by being in the store, but I get even more, sometimes 50 cents or $1 more on one item just by using the app. A lot of people don't do it. Even as I go through the store, hear people, I don't want to go through the headache of another app. Okay, well, I'm saving a lot of money. Consistently, we've been doing it several months now. We save 30% on the list cost, sometimes up to 40%. We get the buy one, get one free stuff on numerous items. And we also build up points for everything we buy. So even though we're getting the discounts, we build up points, and then we get additional dollars off of our bill. So there's all these different ways it's working for me. And then on top of it, when I go to the store, I either I can use my debit card and get cash back on it as well. So all of those things begin to compound and work in my favor. And on top of that, there's other savings apps that I use that you scan in your receipts, or that you can link your payment method to, and that type of thing. And they have additional rewards. Like, I signed up for rewards at a gas station recently, and they were giving me 30 cents off a fill just for creating a simple account. I didn't have to get their credit card or anything like that. I just created their rewards account, my email, set it up, and then I have my account code that I enter, and I've been able to do that. So there's a lot of ways that you can shop smart. And the simple thing here I want to emphasize is it's about the habit. It's about a habit and mindset of frugality more than anything else. Just like I mentioned with fast food, eating out type stuff, and getting the apps. Even a lot of sit-down restaurants have some type of app these days. And so it is a little bit of time, but you can save big time by doing that. And you can avoid paying for, like your Amazon Prime membership by just wait until you need to check out with above whatever the minimum dollar amount is. I think it's like $35 or something now, in order to get the free shipping. So there's ways that you can do that. And on that note as well, on some of my online shopping services like that, there was one that I don't know if they're doing it anymore, but it was a tremendous benefit when they did it. I wouldn't pay for the subscription model, but I would save up enough in my cart, of stuff I didn't need to buy right now, or plan until I'm going to have enough to get the free shipping. And then if I would allow them to push it back, yes, it's free shipping, but allow them to give another day or 2 on their delivery, they would give me a digital credit, and I would rack up digital dollars that I could use to then through their platform rent a movie for free, because I had the digital dollars pent up, or I could use it for an ebook through that service, put it as credit toward that. And so there were additional benefits. Stuff can be used if you take advantage of those. The other thing, set up an emergency fund. Now, this is a savings thing, but it's a huge difference when you not only have, if you're struggling to put food on the table, and then now you're using a grocery list, and you've gotten rid of some subscriptions, and you have full coverage. That's a huge thing for peace of mind. It's another thing when you get to having $1,000 saved that you have. If you got to be out of work for a few days because your kids are sick, if you need to get a couple tires for the car, Not having to go into debt, it's a huge peace of mind. You have an unexpected trip to the doctor for a cold, or an ER trip because the kids happened, or you broke a finger or something at work, or on the weekend on your own. Having an emergency fund is a huge, huge benefit. And I would encourage, start off with $1,000. And then later on, all the financial gurus out there tell you the same thing. Have 3 to 6 months is the goal of fully funded emergency fund, of your expenses, of what it costs for you to live. If you have 3 to 6 months of that saved, you're in a great place. If the car breaks down, you definitely can buy a rental car, drawing on that savings. Rent the rental car rather than go buy a new car yet. Giving yourself time for the insurance to settle if that's a component, or if it was an accident. The point is, the emergency fund gives you breathing room. If you're self-employed, you might want to think about having up to a year's worth of living expenses in the bank. It just would give you more peace of mind in the ebbs and flows when often businesses are not a straight line. If you work for yourself, or if you work some type of contract or freelance work, you probably have higher months and lower months. And so that helps you to have stability in the event of that changing, or some reason that you might not be working for a period of time, like a disability, short-term disability or something. And of course, it's not a savings. It's not really a savings tool, but it is a protection tool of having disability, especially if you have fully funded emergency fund, 3 to 6 months or a year. If you get that high, I don't know if I would recommend really saving more than that, unless you're like saving for a house or something like that. But then make that a separate savings goal, separate savings account. Even could be helpful. But if you have a fully funded emergency fund, 3 to 6 months, you might not need short-term disability insurance, which is more expensive. Then you can drop that and just have your long-term disability insurance that kicks in after 90 or 180 days, which will cost you less, and yet it provides the protection in the event that income, something were to happen. Take advantage, as I mentioned before, of your employer benefits. Get that retirement match if it's available. Take a look. It's open enrollment time soon. Take a look at your health coverage options that your employer provides. Or even if you are shopping the market yourself, out of choice, or being self-employed, or in between jobs, or any of those situations where you might be looking on your own. There's healthcare sharing stuff out there, as well as traditional insurance. And the other thing is, work with a broker. Find somebody that can quote from multiple companies. That'll help you be most effective with your time and see if there's value. And then really look into what do you need. If you're fairly healthy, if you basically just go to the doctor for your annual checkup and like occasionally because you got a cold, then you might be able to get a higher deductible plan, which could have an HSA component, a high deductible plan where you have a higher amount that you would have to pay out of pocket in the event of a major medical catastrophe happening before they start kicking in more coverage. That allows you, if it has an HSA component, health savings account, to have tax advantages, as well as to have something that you then can set aside savings specifically for health savings account in. The other added benefit of it is, not only are there tax advantages to it, and not only is it something that is specifically health-related expenses savings, but after you build that to a certain amount, most of your HSA companies let you invest. So you get above, let's say, $2,000 or something like that. Then they let you invest the other money you put in there. So let's say you have a $6,000 annual deductible and a high-yield medical plan. You're pretty healthy. You can afford to do that. And then you're putting in the difference of what you would be paying for another plan. Put in that difference into the savings of the HSA, and it grows, and then you reach that kind of like a emergency fund, what they want you to be able to access depending on your HSA service. You get past that dollar amount and begin to invest the other, and it's almost like a HSA health retirement plan, if you want to think of it that way, long term, or if something were to happen. And so there's a lot of benefits to that if you are healthy enough to consider that option. If you have health concerns that would make that a risk, you'd be paying a lot of money out of pocket, then look at what deductible may be able to allow you. Would a $3,000 or something like that? Maybe right now you have a $500 deductible. Maybe you can afford to get it to $1,000 or $2,000 or $3,000. Look at that and where you might be able to save, and it can make a big difference in giving you some margin. You might have pretty similar coverages just in terms of what the insurance is going to pay, but your price will go down if you're going to pay a higher amount before it kicks in their coverage. That's how they run their rates. Invest long-term and diversify when it comes to saving. And I do just want to mention this. A stock market crash is very, very unlikely. The reason why, there's a lot of companies. Every company that's on the market would completely have to close their doors. Major catastrophe. If that happened, we have much bigger problems. If every single grocery store that's traded, every single company, every single lumber and home supply and home goods company on there, if every business crashed, then you have a problem. How do you protect yourself from the event of the dips and the recessions? Well, invest long-term, diversify across multiple sectors, multiple industries. Don't hold individual stocks. That's very risky. Look at mutual funds, that type of thing, as Ramsey suggests, and then diversify in, as I mentioned, multiple categories. Now, Dave has a way that he's talked about that, like diversifying even by percentage into certain types of funds and certain types of businesses. But in a very brief amount of time, you can get a pretty good grasp of an education on how that works, and then you can make a decision. I also want to encourage you with this. Ramsey did a study of everyday millionaires. The vast majority of them are normal people. Actually, one of the highest job categories that became millionaires were teachers who didn't have very big incomes, but they had the discipline of saving little by little and over the long term, and of diversification. They understand these things from teaching, and they put it into practice, and they consistently have done it. But one of the things that they found about millionaires is the average millionaire, they did it by taking advantage of their company match, living below their means, focusing on paying off their debt, even getting to that American dream of paying off their home and owning their home in full. But they did it by using the employer match, maxing out that employer 401k, maybe maxing out their individual Roth or individual IRA. That's how they did it. They weren't crazy. They just continued little by little to do it consistently. $100, $200, $300, $400 a month, whatever it was. They just continued to do it over time and over years and years and years, the compound interest effect. The other thing is how they did it, how they chose their investments. They chose their mutual funds by only spending 10 or 15 minutes going and reading the prospectuses. They learned how to read financial statements, for lack of a better term, and to look at the track record of investment, and they chose investments that had a good track record. That's all public information, highly regulated. How is this investment performing? When did it dip? What does it do? Is it a brand new investment? Then you're going to take some risks investing in it. Has it been around for 40 years, 50 years? Well, if it has, you have some serious data. You can look at it, how it's performed. And if you know what different markers in history did, like the 2008 recession, that thing, you can look back, how did it perform during this? And if it performed pretty well or didn't lose as much, hey. So it's not a very complicated view. It's just taking some time and making a good choice. And you know what? The investments that those everyday millionaires chose, some of them were good, some of them were not so good. But the key reason why they reached millionaire status was consistency. They just kept investing. They just kept choosing based on some research. They didn't just throw it. They sought to understand what they were doing. They didn't win 100 out of 100 times. They didn't bat 100 out of 100. But they did really well. Then I do want to mention this when it comes to insurance, and then we will wrap up with the questions. I know we'll be just a minute or two over, and some closing thoughts. On insurance, I would not recommend whole life insurance. It's also known as cash, variable. There's a whole bunch of names and a whole bunch of different components to it. It's a very complicated financial product. On average, though, the investment portion, the reason why people tend to want this type of thing is they're sold on the tax benefits and they're sold on hacking the system. Let's get myself some life insurance, $100,000, $200,000 of life insurance. And I get to put money into it, but I also get to build up something I can borrow against it myself. I can borrow my own car note from myself or something like this. On average, what you're actually making, paying into this thing for years and years and years and years, is you get less than 1% return on your money. That's less than most banks. If I would have put my money in the bank over the period of the same number of years, I would have had more money, is what this is saying, especially if it's in like a high yield savings account or a money market. I could have made more than buying this product. The other thing is, it's insurance, life insurance, yes, but it has all these other components to it. The return is very low. What's happening is you're paying the insurance agent's commission. You're paying the insurance companies what you're really doing. And your coverage is much less than other pure insurance. If you get term insurance, which is you're paying just for the insurance, you're not building any cash value or anything you can take a loan against. If you don't pass away before the time of that contract, life insurance term of that contract is up, then you don't get anything. If you were to pass away suddenly during that time, then your family, beneficiaries, whoever you've set up your estate, would get that. It's pure insurance. It costs often like 10 times less because it's only the insurance. The other thing is, you might be paying $200, $300, $400 a month for a $100,000, $200,000 life insurance policy, so that when you die, your family gets that amount of money, $100,000, $200,000. It's very likely that you could get, especially if you're like your 30s to 40s, and you can look up the average rates on this. I can't quote your exact situation, but you're probably under $50 a month to have $500,000 or more in coverage if you're in like the ages I just described and pretty healthy. So it's definitely worth your time understanding how these work. You're not going to hack the system. Those are insurance coverages to remove risk and to provide extra protection. They're not a savings tool. They're a protection tool, just like car insurance. Car insurance doesn't save you. It's not saving for your retirement. It's protecting you in the event of an accident, of the car bills, the financial loss, or the medical bills associated with that. All right, so as we are going to now move into the next portion, I'm just going to pull up my other screen here, take a quick look what type of questions and stuff we got here, and the ones that I have in my list from prior. A common question a lot of people like to ask is, how much should I save each month? The answer to that is, it's up to you. But I would say this, something small can have a big benefit. So for example, if you wanted to invest $2,000 a year, you want to save $2,000 a year, and let's say invest it for your retirement. Okay, so $2,000 is how much you want to save this year. How much do I need to save a month? Well, divide that by 12. That's $166.66, and then it's 66.7. So 67 cents somewhere in there to make sure you reach that goal. Maybe just round it up to $167. And if you round it up to $167, you're going to end up putting in $2,004 over the course of the year. But here's the thing. You put that in, and you keep putting it in every year, and the interest builds on the interest builds on the interest. So how much would you save each month? Well, where you would like to get, most financial gurus would say, you want to get somewhere between 10 and 15%. If you can do better than that, great, but 10 to 15% of your income. So if you're making the $50,000 a year example we used before, 10% of that would be $5,000 a year that you'd be saving. If you want to put in 15%, that would be $7,500 that you're saving. And that is particularly money that you don't want to just be saving this for emergencies or for like your emergency fund. Once that's done, once you pay off your house, these are long-term goals, but once you reach those, you've paid for your next car in cash, you've saved up for that. Once you've done these things, really what the goal of that 15%, that 10 to 15% is to be investing that. Not just saving it, but then have that money work for you. Invest it, and there's different ways to do that, as we've discussed, and you can talk to professionals to specifically get advice about your situation. What about this one? What is the best way to pay off debt? Well, sell so much stuff that the kids think they're next. Sell everything, take on every bit of overtime. Honestly, getting more income is one of the best ways, but what about prioritizing? Well, focus on the highest interest debts first is the way some people will say to do this. What actually tends to work from a motivational standpoint better is the debt snowballing method that Dave talks about a lot, that Dave Ramsey talks about. It's not always going to save you the highest interest rate, but here's what's going to happen. You're going to keep the motivation to stay intense. And that's the human behavior side that we want to do, because what some of the financial gurus out there will tell you is to look at all the interest rates and all of the different things you're sacrificing. Like, they would tell you never to pause, most likely, your retirement match. However, if you want to get it with your employer, the free money there, never give that up. However, if you pause it for a year or two and you're really working hard, an extra job, you're selling junk you don't need out of the house, you're taking on extra overtime, you're doing this, you're really intense, and you're paying them off as fast as you can, another one, till it's done, you're going to be much more motivated than if you try to juggle all these things. It's true on a percentage level that maybe you are sacrificing something, but it tends to equal out on the grand scheme of things if you really look at it and you look at the lost motivation and of having everything spread too thin. So what I would say is use the debt snowballing method. And there might be a couple of exceptions to that. I'll share one illustration in a moment. And then I'll answer one more question and then we'll wrap up. Apologize, we're going a couple minutes over, but there were some good questions here, and I want to address it. So when it comes to the debt snowballing, what that means is you look at the lowest dollar amount debt first. So don't pay attention to the interest rates. If you have credit card debt or whatever, make your minimum payments, but then after that, whatever additional money you have to start paying, you got $100, you got $50, 25, 500, you've worked a ton of overtime, whatever you have that you're going to pay additionally to pay down the debts after covering the minimum payments, pay the smallest off first. You might have a couple $100 one. You might have $1,000. Pay as much as you can toward that one until you get rid of it and then go on to the next one. Now, I would say that one possible exception to that from a emotional standpoint, and again, it does matter on the numbers here, but a personal loan. If you owe family or friends money, I would encourage you to give serious thought to paying that back first. So let's say you owe $300 over here to something, $500 over here, and you owe like $1,000 to your family. You know, I would possibly say make an exception there. Pay off your family first, because that adds a whole dynamic to your relationship. And, you know, if they're your friends, it adds a whole other thing. There's a relationship component there, because these people care about you. And then secondly, make the commitment, I'm never going to borrow again. Okay, I'm not going to borrow from family again. I want to pay them off first. I don't want that strain on our relationship, and then I'm going to start attacking these in the order of, as I mentioned, lowest to highest, so that I take one off and I have that minimum payment to begin to apply as extra to the next one, and any extra money I have, and it just keeps snowballing until you build massively and knock it out. The last question I'll answer, and then I have some exciting stuff to share with you as we wrap up, is how do I build good credit? Well, the traditional answer to that is to pay off your credit card and pay off your debts. All that a credit score is an I love debt score. How reliable are you for making your payments? Now, the biggest reason that comes into play many times is when it comes to a house. A lot of people are not going to wait to pay for a house in cash. They're going to take out a mortgage at some point. You don't have to have credit history in order to get a mortgage loan. There are companies where you can get around that. The way you get around it is you go through a process that's more akin to the camp you're going to be in if you're self-employed. So if you're an employee, they're going to typically say like, oh, show me your W-2s from the last couple of years or something, a bank or a mortgage company. If you're self-employed, they want to see your tax returns because you don't have W-2s. They want to see how much money you have here and you know, in your different accounts and that type of thing, because they're looking at your risk from a credit perspective. A creditor has to assess the risk, and that's going to affect the rate you get on interest and stuff. But for a home, which is one of the biggest things you would be taking a loan out for, when it comes to cars, there's a lot of companies out there that have in-house financing and stuff, and so your credit score is not necessarily as big of a factor. But again, it's an I love debt score. So if you're focused on living a debt-free life, you can pay cash for a car. If you're not in that situation yet, you can buy a less expensive used vehicle with a smaller loan and pay it off faster. and then be able to begin saving for your next car and apply a trade-in of that vehicle for your next one, as long as it's running by the time you're ready for your next purchase and it makes financial sense. Don't buy a car just because of looks or status. It just doesn't matter. Buy a car for transportation, for what it's going to do for you. Yeah, that's what I'll say on that. But on the mortgage side, as I was saying, there are other ways. You don't have to have a credit score. You don't have to have a credit score to get an apartment or something either. What you very well could do when you're first getting your first apartment, if you don't have a credit score, I mean, I've encountered this because I didn't have debt, was I had to pay a larger deposit the first time around. But then my second time around, when I moved to a different rental situation, and they had my history. My history had already been, I rented in this other area, and I moved to a pretty close by area, and they didn't require any deposit, which was awesome. I always paid my bills on time, and so they were able to look at that history. When it comes to getting a mortgage, you can go through the process of them looking at your W-2s, looking at your tax returns, looking at how much money you have in savings and stuff. Like, they look at a full picture of your credit risk there. And the other thing is, they can look at, do you pay your bills? It is a little bit more legwork and it takes a little bit of time, but have you always paid your electricity bill on time? Have you always paid your bills on time? If you've rented, does your landlord, if it's an individual landlord or a small company, or is it a big corporate service that manages the property from, can they simply provide a letter of, yeah, they always paid on time? You can provide what they're looking for in terms of the credit. I'm paying my bills. I'm just doing it from a place of paying it off in full rather than paying a portion of it. There are ways around that. I would say you don't need a credit score. If you're absolutely committed to it, of course, there's the old-fashioned way of have a credit card and pay it off every month. But you very well may find the easiness of swiping the credit card psychologically, it doesn't feel like you're spending the same because it's just swipe it. Psychologically, you probably will end up spending more. You could, I should say, end up spending more. So when it comes to your spending habits, how can you minimize not thinking? How can you maximize thinking intentionally about what you're saving? If it's a debit card where you have to have the money to spend it, if it's using even those app services I described, rewards apps or something to maximize your savings, each one of these steps is a habit that helps you be more intentional about thinking about what you're doing. And so that's going to help you be a better manager on your spending side. Even just Googling discount codes when you're about to place an online order for whatever that website is. My wife and I did that one time actually for something, and we were able to find codes. We saved like 65, 70% because there were just so many codes out there that we could apply. There were tons of specials that this company was always running deals. So a little bit of time. Couponing may seem old-fashioned, but it works. All right, so as we wrap up, and I do apologize for going over, but I do trust it's been well worth your time. I want to talk about the conclusion now of some exciting ways to continue the interaction and some stuff that can help you moving on from this webinar. So taking control of your finances, as we've talked about today, it starts with understanding the basics of budgeting and saving and spending, and flexing those muscles and developing really micro habits like that. That meal plan is something you develop, a grocery list. They're not huge habits. They take some time and they take getting used to, but then they begin to compound and really pay off. I read something this week, something like 46% of your life, a study showed, is all based on habit. 46% of all the decisions you make and all the things you're doing every day are habits you already have in place. So let's establish some micro habits that are going to really make a difference in the realm of your finances. Same thing applies in terms of time management and stuff. Would love to chat with you about that. Maybe I'll do a webinar on that sometime. Feel free to comment and tell me if personal growth topics like that would also be of interest to this audience. By implementing those tips that we've discussed and building these habits and intentionally do some research, seek out answers to the financial questions you have, then you can build a plan. You can build on that solid foundation, and you can begin to move toward future financial success. Again, just making marginal improvement is still a win, and celebrate that. If you're 1% more effective with your finances now, than you were yesterday or than you were last week, you can make tremendous impact. And I just want to say this too. We're just about to move into November. We're going to move into all the holidays of Thanksgiving and Christmas and all the spending and stuff that surrounds those holidays. If you simply take this advice and these tips we've talked about today and begin to put them into practice, you literally can make not just 1% improvement. You might make 10%. You might make 15% improvement. I think about somebody that I began the conversation of coaching with about 15, pardon me, not 15. I'm thinking of something else. Began the process with probably about a month and a half ago. And they're doing 10 to 15% improvement in their finances, like margin already. It's amazing. And it's amazing how they might have even found some things that are going to move it up to 20 or 25% or 30%. They have some other potential things in the works. So it can really begin to make a huge impact. 1% may sound a little discouraging, 1% improvement. 30%, wow. And then just continue to grow, continue to flex the muscle and to invest in growing in this area, and it pays off. All right. So I hope that the webinar has given you empowerment, not overwhelmed, but hopefully empowerment today of some great tips. Here are some of the things I've been talking about of the offerings I want to share with you. One is financial coaching. So financial coaching is that we hop on a call. I work with men, I work with couples, and those are my specialties in this area of hopping on a call and getting into actually me asking questions about your situation, learning your story, and then identifying action steps together that work for you. So financial coaching, it's like the personal trainer method of personal finance as opposed to like an educational method like this of watching a video. Or of commenting a question or something like that is more of like a group, like a Weight Watchers group or something like that, a grief share, some type of group program. Those are also helpful, but they're not as specific. They don't have as much time to devote specifically to you. So I do offer those services, would love to talk about that with you. I also want to share with those of you that are already familiar with the coaching, and maybe you're not, but this could be of value to you as well, that I am expanding my coaching and in the process of this now, and I've been having men coming to me that are in transition, and there's other types of things they're also wanting coaching in. And so this is fleshing out what this expanded coaching offering looks like, and there's some different packages. Helping to guide men into transformational impact, okay, it's actionable, in their interaction in their home, their church, their culture, their business. It's been awesome to see this fleshing out and to see the wins that guys are having, but it's actionable. So experiencing that transformation, that impact through action, building burnout barriers, improving time management, developing rest habits. That's part of the burnout and time management. They all go together. Margin creation, creating margin so we're not spending every ounce of energy and every ounce of time we have. Finance, we apply those things like we have today. Serving through your business, not just selling, not just doing business, but looking at it as a place of service and how to serve your customers, and strategic operations. We've talked about some of that in a financial sense today, being strategic with like take advantage of this match or whatever. How can you be strategic from a personal perspective or a business perspective in that? Now, beyond the personal and the individual, there's also several options available I have for individuals and organizations. For example, I have a seminar I'll be doing in January and possibly a second one at that same trip in a nearby area and fleshing out some details there. There's also the ability for me to come in and do like a Zoom class or something. Sometimes churches and community organizations want that. In December, I'm going to be speaking at a library to business owners about how to apply these things, small business finance and habits. But there is an offering I have for organizations that I have put together. And so I really have honed this toward wanting to serve small businesses. Small businesses have a desire, family-owned businesses and small startups and businesses that are smaller, like a dentist office or something like that, that they're never going to have hundreds of employees because it's one location and family-owned or it's a branch or something like that. A small business has a particular set of challenges before them. there's financial barriers. They want to serve their employees well. They don't want to deal with the headaches of turnover and stuff. Really, every company would like to serve their employees well if they have a healthy culture. So one of the things I put together is a way to help train employees on how to live more than paycheck to paycheck and to maximize their benefits, as well as some other areas that I'll mention in just a second. But a lot of folks are struggling right now. A lot of your employees are struggling. They're living paycheck to paycheck. What if a workshop or a couple of times coming in and doing specific training for the whole team could help them in that? Or maybe you don't have that type of offering to do like a workshop or something. Instead, you could afford to offer so many financial coachings free a year. And we could discuss what a package like that would look like, to where then they could reach out to me. I know a lot of companies, even that I've worked for on the corporate side, they have different types of coaching services that people can reach out for. Or there's the counseling type of service as well. With mental health these days, the companies want to provide a benefit for their employees to access. It's up to the employee to do the process of taking advantage of that, but it's a benefit that can be offered. The other way you can do it, is to offer so many coaching sessions for free, like I said, or a discount. So that's a partnership where the employee gets the coaching, but you're matching dollar for dollar up to so many times, or up to so much, to be able to help them grow in this area. So would love to talk about that, because small companies, they can't afford an HR department. The small business owner doesn't have the time to do all these things and help do all the personal training to help their employees take advantage of the benefits they've worked hard to put together for them, and to help them learn how to budget and such. You have other things to do as a business owner than serve your employees in that way, even though many small business owners I know, they're the salt of the earth. They want to help in these ways, but it's too much for you to do. So those are ways in which I can serve small businesses, as well as doing workshops and training for time management, micro habits. I referenced some of those things in regard to finances today, but there's a whole lot more to it. And so would love to talk to you about that. And then lastly, I want to say this. For those that are interested, I do have a private coaching group. And if you're interested in that, now that's a group approach, please feel free to contact me. Just send me a message here through Messenger, and would love to have that conversation with you. Thank you all for your time. We did go over today. I do apologize for that, but I do thank you for your time and attention. And please let me know. Let me know what tip you got out of today. And for those of you that may not be interested in the different offerings and stuff I mentioned, I do want to give you this challenge. Who do you know? Who do you know that needs help? Who do you know that needs help in budgeting? That these savings tips I talked about today would mean a lot. Either let them know about personal coaching. If you want to be incredibly generous and offer to pay for a month of coaching for something for them and gift it to them, would love to talk to you about that. Would love to partner with you in serving someone that way. But also, I do want to throw out there, simply reshare the video. Somebody you know that needs this type of thing. Who do you know that this can help? Let's help somebody. Thanks for your time. Thanks for your attention. It was a joy to serve you today.